Hey everyone, this is Kirk here again at Option Alpha, and this is the members only video for May 18th here. What I want to do on this video tonight for you guys is just kind of update you on where we are with most of the portfolio, my general thoughts on where we're going to try to take things, not only for protecting June, which is pretty much built, except for an Iron Condor alert, which will go out tomorrow. And then also one more naked puts and calls alert that might go out this week. So for the most part, April is or May is pretty much done. Everything's gonna expire tomorrow. Today they started expiring on the index stuff, so everything looks really good for April or for May. I'm sorry. Again, we didn't really enter a trade for the Iron Condors. In hindsight, we obviously could have made some sort of trade, but I just didn't feel like the VIX was, cooperating with us. Volatility was so low and premiums were so thin that doing an Iron Condor, we really ran the risk of getting really stretched again with the market if it were to break out higher or lower. Now, again, in hindsight, it really didn't do anything, so we could have, but I don't ever want to run that risk. I don't want to be the kind of trader that forces trades into the market just because I have to make a trade. I want to make sure that these are good, profitable, and secure trades for you guys. What I wanted to go over first tonight is USO. This again was something that we did a little bit different on the naked puts and calls strategy, and of course some of you here are not subscribers to that, but you can get a flavor of what we're doing. A little bit off topic, and when I say off topic, it's because we are usually doing things on the index ETFs, right, like everything else. But I found that this is a really good trade for us this month because we could get it way down here below 30. And our strike is at 28, which is again way, way, way below 30 here, not even on this chart. And I think what really is representative of the type of trade this is that it's a really safe trade. It's below a lot of support levels. These green levels or boxes that I've drawn are really times when USO and the oil markets have had really dramatic shifts lower. And so what I did is I replicated the same box for not only time frame but also for price percentage movement. And you can see that all of these boxes here are relatively the same, and they're pretty equal in their size distance. This one's a little bit longer. But what I did is I kind of threw it up here on this most recent chart of USO and said, okay, if it does the same type of move that it had done in the past, assuming the worst case scenario, where would that end up? And it looks like 35 is going to be the max that it could go to the downside. Now, we've already had a really good sell-off and are seeing a pretty good bounce here at this 38.5 kind of support level that we've seen that I already drew before. So I know that we're really safe on this trade. Again, it's all the way down below 30, so we'd have to crack through 35 and through the 31.5 here. Again, that'd be a massive, massive hit. And still, we wouldn't even be at our strike price. So again, very, very safe trade here. Really, really like this trade. Just to focus on something else, obviously, other than the indexes, SLV is another, the silver shares, which I actually thought was going to have more of a bounce and a bear trap, as I would call it, on this bubble here, where SLV actually bounces a little bit higher, maybe up to 42, 43, then starts to roll over, but it seems like it didn't have really any bounce at all. So it's not that it doesn't or it can't have another bear trap. It just may be coming later. So, but just be careful of that. I think that there's definitely the possibility that there could be some renewed interest in SLV at these prices, right? Everyone saw it go up close to 50 and now it's back down here below 35. So you're naturally going to have people coming in who don't look at charts and want to start buying up silver and SLV in particular. So you could see a very, very good bear trap start to come into play. So if you want to play this with options, some short puts or some long calls, whatever you want to do, obviously that is your choice. As far as the dollar is concerned, the dollar's been one that I think is really, really interesting. It's broken out lower, as we had talked about before, but now it's regained some of that ground here, and you can see it's come back up to these support levels. I think what's really interesting with the dollar is that it's having a tough time getting past this level right here. And just this one level in particular, you can see that it bounced off of that level a couple times, broke down below it, and had a retracement here. And that's really key for this, is showing how strong this level is. It had a retracement on some pretty high volume where it comes back up underneath this support level, now acting as resistance before falling away hard. Now we've regained a lot of that ground here, but we could start to see the dollar continue to weaken for a little bit until we hit the end of June where QE2 ends. And I think that this level will get easily broken through once QE2 ends and hopefully some stability to the dollar comes back into play. So I think that the dollar short term is going to look weak, but as we start getting into June, I think that it's going to definitely strengthen considerably. Now, as I start to look at the S&P and the Russell and some of the other things, and you can see some of our credit spread trades are down here. Everything looks really good. It seems almost too calm right now. Every dip in the market is getting bought up, seemingly as quickly as it fell down. You can see we've already started this mini rising trend on all the indexes where every dip, again, it just seems like a quick stairway. And now we're, today may start off with, another 4 or 5, trading days higher. But I think that it's just real eerie the way that the market is trading right now. We're definitely in this lower channel in the market right now. So if we do go higher, we could see 1375, no time at all. But I think that if we break down below this trend line here, I think that probably 1250 is not too out of the ordinary or unreasonable to think that the market can get down there in a hurry. Now, obviously, all of our trades are well below that price point. So I think that we're going to be safe so long as the market doesn't get down there in a hurry, which is why I've suggested to people use this opportunity where the VIX is low to start buying, out of the money protection. And when I say out of the money, 1150s, 1100s, anything that's going to protect against a volatility spike where you can make some money on a volatility spike. Now, obviously, you're not going to want to protect it 100% at this point, but you do want to start buying some of that cheap protection out of the money. For the Russell, it's not as great of a picture as the S&P. You can see that we definitely have broken some trend lines on the Russell, same type of outer kind of channel trend that we're in right now. But for the most part, it's cracked a couple times before, so I don't know how strong the Russell is going to be in relation to the S&P. I think that where the Russell is at, generally, it's just obviously a higher index value, so you could see a little bit more downside risk, right? But again, we're still well below the peak over here in April, and then it also ran a resistance in November, so all of our strikes are well below that point. It'd have to be some really good selling to get us down to that point. But again, you never know what's going to happen, right? Call side spreads are very, very thin right now, and it definitely is a better trade on the put side. So I hope this has been helpful for you guys. As always, please email me with any questions or comments, and happy trading.